Picking up on your discussion about this time being different, you can make that argument with respect to COVID, but it's also an argument people have been making for a long time now with respect to what's been going on in the market in general. When we look back at the past decade, things that have worked over long periods of time have either not worked as well or not worked at all. So things like value investing, for example, or buying high quality companies. If you were to look back now and say, what was the best investment strategy over the past decade, it was probably something along the lines of buy expensive, high growth type companies that are large cap, something like a combination of those factors. And, there's several reasons people have cited for that. Some have cited the fact, Fed policy. If the Fed has artificially suppressed interest rates for a long time, that might be a better environment for those growth type companies than it is for maybe the types of things like a value investor would be looking for. Yeah. Or some others have argued that maybe it's a fund flow thing, and if you have these regular contributions coming into 401ks and those contributions are mostly going into passive funds, then those funds are being invested irrespective of price. And so that could continue to drive up, the more expensive companies relative to maybe the cheaper companies. I'm just wondering how you look at all of this and what you think the outlook is for fundamental investing going forward and what you make of this past decade in terms of what's happened.
So it's a great question, because if you look at the return for stocks in the long run, if you deconstruct the returns, right, over the last 100 years, stocks produce return roughly about, let's say, 11% a year, more or less. But 6% came from earnings growth. I'm sorry, start over. 11% a year. About 6% a year came from price appreciation. About 5% a year or so came from dividends. Okay, if you deconstruct the price appreciation, then you would see that the return basically comes from two sources: either the earnings growth and price to earnings, either going up or down. So over a long period of time, the price to earnings movements kind of cancel out. So really what matters in the long run, so if price to earnings, in other words, if price to earnings has not changed in 100 years, really it would be just earnings growth and dividends. That's what explains long-term movements in the stock market. That's all that matters, right? Now, let's put dividends aside for a second and look at the stock price of the stock appreciation over the last 10, 11 years. And what you find is that the earnings growth for the economy in general wasn't that great anyway, okay? And most of the return for stocks came from price to earnings going from average to much above average, right? Now, if you look at these stocks, if you look at value growth stocks, right? So growth companies, what it means is that basically companies that grow in earnings at a faster rate, right? But so what you also find, so they get some tailwind from earnings growth. So the earnings are growing at a faster rate than average company. We get that. But what you also would find that their price to earnings have expanded so much more. So if you were a kind of a growth investor, you benefited from not just from earnings growth, but also you benefited tremendously from price to earnings going up a lot. At the same time, value stocks that have a lower earnings growth, their price to earnings actually declined or hasn't moved much. So you have that dynamic going on. So the question is, why did it happen? Well, I would argue it's very similar to like value versus growth is very similar as like short-term bonds versus long-term bonds, right? Short-term bonds have a short duration and long-term bonds have a long duration. So when interest rates decline, bonds that have a longer duration, the 30-year bond, would go up a lot more than a 5-year bond. So growth stocks have a long duration, that's why they benefited, and value stocks have short duration, that's why they haven't either remained flat or decline actually. And in fact, you would argue, and this is the point to the flows, because indices constructed, especially the big indices like S&P 500 is constructed based on a capitalization. The larger the company, the more space it takes in the index. Therefore, when you have inflows into the stock market, the money flows into larger companies, and those larger companies were the ones that are growth companies, and that benefited them. And so I forget, like the top 5 companies in the S&P 500 are 21% of the index or something like that. And so that's part of what happened over the last 10 years, so.
Yeah, I'm sort of wondering, the thing I think of as a value investor, we're very different than you because we're quantitative value investors, but we're both trying to buy based on value, are we in trouble until these things reverse? So if the Fed continues to do what it's been doing, and you can argue that a lot of the consequences of what the Fed is doing will be felt more in the long term, and maybe more of the benefits are in the short term. So they might keep doing it for a while. And if these fund flows don't reverse, if more people keep getting passive, and they keep putting more money in the bigger stocks, do we need those things to reverse for us to do well, or can this get to such a point that it gets so out of whack that we can do well even if they don't?
So I think we may approach kind of the 99 2000 point at some degree, where if in 2001, if you were a value investor, that was one of the best years. It paid off all the previous pain you suffered through. You got paid off handsomely. So we may get. So the thing is this: the price to earnings is a pendulum. So when your return comes from price to earnings going up, price to earnings is a pendulum that at some point when it stops going up, it actually doesn't just stay there. It starts swinging to the other side. In fact, my first 2 books, the Active Value Investing and Little Book of Sideways Markets, that's what they talked about. I studied that, and I realized that it's historically price to earnings went from below average through average to above average, and when it mean reverted, it didn't just come back from above average to average. It's historically usually went to below average. So I would argue that I don't know when. So you asked me a question of when, and I have no idea. And I'm basically investing as if the music will stop at some point. The famous words of Chuck Prince of Citigroup was, why was he doing crazy loans in 2007, 2008? He said, well, we were dancing while the music was playing. And if you are responsible managing somebody else's money, that's not the right thing to do.